Holy! I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, it's my most shocking video of the year as we have new evidence that shows that layoffs are about to skyrocket. Plus, while investors have gone mega bullish about stocks, I'm going to show you one chart that's going to completely change your perspective on where stock prices are headed. But before we get to that, I want to talk about the political fallout from the Fed's interest rate announcement and why all the politicians got it wrong. Now let's head over to Bloomberg, where he picked today's story up with a headline: as Trump decrees Fed rate cut is a political move that won't work. And while the Fed claims political independence, we know that's not quite true because Fed chiefs are appointed by the president. But at the most recent press conference, one of the reporters asked Fed Chair Powell what he thought about Trump's idea that a president should have influence over interest rate decisions, and his claim was that independent central banks around the world, they had lower inflation and better outcomes for the public. Of course, we know that this isn't entirely true because they are influenced by politics, but this recent move perhaps had more to do with the labor market than politics. It was a really political move. Most people thought it was going to be half that number, or a quarter basis point cut, which probably would have been the right thing to do, Trump said in a recent Newsmax interview. So it's a political move, he said, to try to keep somebody in office that's not going to work because the inflation has been so bad. Well, it's not going to keep anybody in office. And this is one of the big myths, is that you can bring inflation down without a recession. So in fact, the high rates of inflation really aren't good for an incumbent party at all, because as we noted, recessions do not lead to re-election. Let's take a look at this chart here of the consumer price index, and we can go back in history and see periods where inflation ramped up and then came down, perhaps many times due to central bank influence of raising interest rates. But what do you see? A gray shaded bar shows up, and you see it happens several times here in the 60s and into the 70s. We get three instances of it. You have it happen in the 90s, 2000s, the global financial crisis, and now we're coming off one of the hottest run-ups of inflation since the 1980s. And the belief is, of course, perpetrated by the Fed, that they can engineer a mythical soft landing, but the reality is they're going to push us in a recession. So here, rate cuts don't actually make a difference. It's all about inflation, and that is not good for the incumbent party as it comes down. And lowering interest rates isn't a declaration of victory, Biden told the Economic Club of Washington, D.C. It's a declaration of progress. Not sure what he's referring to here, because he says it's a signal we've entered a new phase of our economy and our recovery. And this is a notion that if you bring interest rates down, that the economy recovers. But the problem is, even as you just saw, we bring inflation down, there is no recovery. You get a recession. Because one of the challenges that the political elites don't understand is that lower rates lead to tighter financial conditions. And when that happens, you usually get a recession. In fact, it's the Fed who causes them by lowering rates. We can take a look at this chart here, and we talk about ushering in some new progress here. Well, the progress doesn't look good, because we're going to look at the federal funds rate in red against the net percentage of domestic banks tightening standards for commercial industrial lending. Now, we're going to go back here into the 50s and 60s, and what do we see? Fed rate cuts lead to recessions. Then in the 70s, we see it happen again. It repeats in the 80s and then the 90s, but now we get some very clear data about banks and tightening lending standards. And what do you see? As the Fed cuts rates, banks tighten standards. That's anytime that blue line is above the horizontal black line. And what that means is they constrict the creation of credit. Well, in a debt-based economy, you need a constant supply and an ever-growing supply of debt to continue to fuel the economy and to pay on all the existing debt. And what do you see again? Fed rate cuts lead to recession. Now we're at the beginning of that cycle. The Fed doesn't want you to believe it's the beginning of the cycle. And out of two sides of his mouth, Powell said, this isn't the beginning of the cycle, but at the same time, he did say it is the beginning of a rate cut cycle. Just don't expect 50 basis point cuts to be the norm. The problem is they're going to be the norm, and in a big way. You may have seen this headline today as nuclear names surge after 3 Mile Island plan restart to power Microsoft data centers. And this was a call we nailed back on September 13th. We gave our CTA Timer Pro subscribers the word to buy uranium at open on that day. And look at this is a note we tell people. We ran the back test. We look at this as a high probability trade. We looked at all the data. We said you should buy this. At a market open today, this trade was up almost 5%. And you can take advantage of this too. In fact, heading into today, we had an 83% win rate on our CTA Timer Pro. Our Momentum Timer Pro was sitting on a 75% win rate. These are huge. You want to trade and make money? Look at the headlines. We get you to them before the headlines hit. We show you how to increase your probabilities, and it's super easy to use. 2 hours before market open, we publish reports and my opinions. You pick the ones you want, put a buy it open trade with a stop loss, or trade it later in the day. It's your call. Go about your life, and then once a week we show you how to update your stop losses. You choose when to do it. It's your call, and then you put the profit in your pocket. You get the daily reports. You get all the signals. You get my opinion, the backtest data on CTA Timer Pro with Momentum Timer Pro in the works, stop loss levels, full tracking of all the trades and returns, weekly updates on stop losses, 100% duplicatable system here with a 30-day free trial. Links in description below. Start making money when the headlines come out. There should be money in your pocket. There was a big one, not to mention we had one on platinum here recently. But let's talk about the labor market, because things are changing, and that one chart that I mentioned that will change your entire perspective on the stock market. Remember, the data says the Fed cuts 20 times in the past that led to stocks being up double digits in a year. But what if FedEx changed your whole perspective on that? I'm about to show you, because their stock crashed after missing across the board, cutting guidance on weaker demand trends. And this is key, because if you want to talk about a booming market, if you want to talk about soft landing or even no landing scenario, you need to see consumer demand. And one of the first places we see that is stuff coming out of course, Asia into the US, of course, where all of the big exporters are, a lot of the factories of the world are, but then you see it domestically. When people order something online, perhaps it gets shipped, or when businesses need stuff, it gets shipped. So FedEx is usually a good indicator of the economy, and perhaps also the stock market. And here we could see after hours, their stock tumbled 11% as we kicked off earnings season, when it cut its top end of its full year profit outlook and reported quarterly earnings below expectations. Here's the key words: on softer demand for package deliveries. And this is important because when consumers don't have as much money, they don't order as much stuff. Or maybe they actually say, I'm going to cancel all my special memberships and get free shipping, and I'll just bundle up my order, and then I'll get one package, but I won't be ordering near as much. So this is a big indication, as FedEx starts to slow down, that demand for the economy isn't rebounding. So we talk about the Fed's urgency to cut rates. Was it political? No, as you're about to see, has more to do with the labor market and what we're seeing out of companies like FedEx. And when we talk about this one chart, when we look at FedEx's chart, that's the one here in green and red, and you can see there are times over the last 5 years it has surged, and we're looking at that against the purple line, which I colored over in red. That's the S&P 500. Now, on the announcement today, you see FedEx's stock went crumbling down in overnight trading and was headed lower in early trading as investors were looking to get out. But what I want you to see is the relationship between the S&P 500, which hit all-time highs yesterday, and FedEx. Because when FedEx is outperforming the market, it drives the market up and then comes back to reality. But in this case, FedEx is leading the market to the downside. So while investors are ultra bullish, what FedEx is saying is demand is going away. And when demand drops, well, that means revenues, earnings, and profits all head lower. The company said that Q1 results were negatively affected by a mix shift, which resulted in demand for priority services, increased demand for deferred services, and constrained yield growth. So we talk about priority services, and what is that? It's when people need to get stuff and need it now. And a lot of that is business to business customers. And you think about this, you get an order for something into your business that a customer wants, you need to build it, assemble it, construct it, whatever you're doing, and you find out you're out of a certain part, or maybe a part you needed is broken, so you put an order in and you don't want it to wait. You need it now, because the sooner you get it fixed and shipped out your door, money in your pocket. But you notice there's a trend being pushed back to deferred services. And why is that? Because when factories start pumping out too many things, warehouses start getting full, you all of a sudden you don't see as much demand and much of a need, because what you're seeing is retailers and wholesalers say, well, look, we need to bring our inventory down. We don't need stuff now, but we might need it later. So what FedEx is saying is there are massive problems going on here, and they're looking at cutting expenses through their drive transformation of what's called permanent cost reductions. Now, you talk about reductions across the board. This means less demand. So things they're going to continue to do, such as have locations open, they're going to close. They're going to lay people off. They're going to cut things back. They're going to reduce their need and demand for the economy, and that is going to, of course, lead to more people hitting the unemployment line. And this is all focused on, again, weaker than expected demand trends. And this is all about their stock price, because they remain committed. And I love this. We continue to manage our capital prudently, which is we're going to close down offices, lay people off, cut expenses, because we need to return $3.8 billion to stockholders this year, because we need to keep our stock price up. And what FedEx is saying is, if you don't do this, if you can't keep your stock price up, it's going to come crashing down. And it's already started to happen, because stock prices aren't a function of buybacks. They're a function of economic conditions and fundamentals. What we're seeing out of FedEx is the market telling them, look, you can buy the stock back you want. The reality is you're not going to be able to continue at that place, because your earnings are headed down. But they're not the only ones, because Mercedes and BMW flash warning lights on China. We see demand coming down and more layoffs about to hit these car manufacturers. And we wanted to do more, they said, but when your biggest market, your main clientele in all sorts of regards, is sitting on the fence, it makes certainty more difficult. And this is because both companies warn on a downshift on affluent customers in China who are growing more cautious, among other reasons. Well, the other reasons, as we talked about, is China's economy is slowing down in a rapid pace, and they're the world's largest exporter. So it makes perfect sense. When the global economy starts to slow down, well, the brakes get hit in China as well. Affluent customers, they start to see their income slow down, their investments start to drop, and what do? They cut their spending in a big way, and that means BMW, Mercedes facing the same problem that FedEx is. And following the guidance cuts, Mercedes and BMW both expect their key profit target this year to be significantly below last year, language implying a more than 10% fall. They previously said it would be slightly below, mean decline of less than 5%. And this is critical, because when you look at these car makers' dependency on China, this accounted for 36% of unit sales at Mercedes, 32% at BMW, and 25% at Porsche. Historically, sales in the country came with fatter margins than elsewhere, because Chinese consumers favored more expensive models. Now what this is going to lead is further increase in the capacity of the factories at these auto manufacturers. What we already know that means is less demand leads to more layoffs. So you're seeing FedEx telling us, look, consumers, businesses don't need to be shipping things as much as they used to, and are willing to defer that till later. Here we're seeing the automotive sector, demand going away, likely to lead to more layoffs. And the evidence of that is clear. As we look at the U.S. data, we have total vehicle sales in blue against the unemployment rate. So what you can see here is, as total vehicle sales decline, it puts more people on the unemployment line. This just isn't manufacturers. This is all across the board, from transportation of vehicles all the way into the sales of them at dealerships. We see that happen here going to the 90s recession. You see it happen once again at the dot-com bubble. And of course, obviously during the global financial crisis, when the banks weren't lending anyway, so no one was buying. And look at now, vehicle sales remain relatively high, but as they roll over and head down, it's going to put more Americans and more workers all around the world on the unemployment line. Of course, what does this mean for their stocks? Well, it means it's headed lower, as their shares fell as much as 8.4%, the largest intraday decline since June of 2020. But look at this. Other analysts are concerned about the company's share buyback program. They don't care how much it falls now. They just care about buybacks. You see that happening at FedEx as well, because what is happening is corporations are putting on floor underneath the stock price. So as the global economy runs out of money and companies cannot continue to buy their stock back at such a feverish pace, what it's setting up is a massive decline decline in their equity prices and the broad markets. And of course, Nike is going to be one of those that's going to bring the market down as well, because they've got it wrong too. They replaced their CEO with veteran executive Hill in a revival bid because they believe it's just a matter of wrong people at the top. Well, the issue isn't that. It's that consumer demand is plummeting. And Nike has tumbled 25% this year as the sneaker giant struggled with falling sales and customer defections to upstart athletic brands such as On and Hoka, as well as to its more established competitors. Donahoe, the former eBay chief and Bain & Company consultant who took over in 2020, has largely been the face of the downfall, of course having nothing to do with what's happened post-pandemic with the surge in demand, followed by an outright plunge as we see consumers lack the money the government was giving them, low interest rates are gone, everything consumers need to fuel the economy is gone. And we can see this, coming back to our initial chart where we looked at the consumer price index. Now let's take a look at it against advanced retail sales, both shown on a year-over-year rate of change. And you can see when prices go up, what happens is consumers can't afford as much, and what then follows is retail sales growth slows. You see that happen here. Going to the dot-com bubble, huge run-up inflation, demand went away. Of course, that meant we're headed right to recession. It didn't matter who your CEO was. The issue was inflation went up, consumers had less money to spend. You see that due to the rise in oil prices heading into the global financial crisis. You see that almost happen as we have a near double-dip recession in 2012. You see it happen again in 2018, and you're seeing it happen now. Again, the view is we just need to replace some executives, get some better products out, and then people will buy. The reality is they don't have the money. And somebody doesn't have the money. Well, that's the Bank of Japan. And another call for a Momentum Timer Pro subscribers that we nailed the other day, as a BOJ lowers the risk of October hike with a cautious hold. Why are they suddenly doing this? It's because the Fed cut rates. The upside risk of prices does appear to be easing given the recent yen strength that's coming out of the BOJ. There's some time to confirm certain points when making policy decisions, referring to the importance of checking on financial markets in the state. Here's the key: overseas economies, referring to the U.S. and the effect that interest rate will have on the global economy. Everyone believing if Fed cuts rates, everything gets better. We know it's not. This is why you're going to see mass layoffs start to begin. Political elites got this wrong. I told you they would, and sure enough, they all don't realize a recession is coming and was likely going to be here in a matter of months. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.